Hey investor friends, I'm Michelle Markey and today I'm going to share my key takeaways of what I learned from Howard Marks, who gave a recent fireside chat at the Milken Institute Global Conference that happened on October 19, 2021. And just to give some background information, Howard Marks is the co-chairman of Oaktree Capital Management, which is an asset management firm that specializes in alternative investment strategies, and they're the largest distressed securities investor in the world, and they're one of the largest credit investors in the world, and they have $153 billion of assets under management, of which I can see that they only have 4% in equities at the tune of around $6.3 billion. So this is just to give some high-level background information about what Howard Marks does, and there's a lot to learn from Howard Marks. And if you also enjoy learning about what some great investors think, I'd love if you could please like and subscribe to my video and YouTube channel, because it helps YouTube share my content with other people who are also curious to learn about investors like Howard Marks, like you are. During the chat, Bloomberg Markets anchor Romain Bostic posed the questions to Howard Marks, and one of the first questions he asked was, given the current state of markets in which a lot of money has been made in the last couple of years, some would say that the markets have been aided, if not abetted, by current monetary policy, and how will the normalization of that policy change the dynamic? To which Howard Marks responded, the question is whether we will normalize, because he says that the Fed and the Treasury have had their hands on the economy, and the question is whether they'll continue to drive it. And in Howard Marks' opinion, he would prefer for there to be the free markets operating with naturally occurring interest rates. And so he believes that that would be a better way to go instead of the interest rates being artificially low right now. But he says, on the other hand, if the Fed and Treasury hadn't done what they had done in 2020, then we could be in a serious global depression right now. So in some ways, they had to do what was necessary, and they learned a lot from the last great financial crisis, and they intervened in a short amount of time so that we avoided worse catastrophes in financial markets. Howard said, though, that there could be some serious negative possible consequences from the Fed and Treasury's actions since 2020, where we could have a strong bout of inflation, and then having a self-fulfilling prophecy of higher inflationary forces could be generally a not good thing for the economy going forward. And then he said, a lot of people would, though, probably prefer low interest rates to high because they can buy cheaper stuff and businesses do better and the Treasury can better service the debt. And so with all that, a lot of people probably would be okay with continuing with low interest rates for as long as humanly possible, as long as inflation doesn't go out of control. And then later on, it's kind of ironic that Howard Marks would say that the question is whether we will normalize, because Romain asked him, how is Oaktree positioning itself, given that some people might be saying that the economy could be overheating? And then Howard Marks says that they're basically operating like normal right now because they're not being too aggressive and they're not being too defensive. So they're kind of just being as is, like how things are going is okay with Howard Marks, it seems like. Even though Howard said that strictly speaking, nothing's distressed right now, and he said the goal of distressed investing, as in all forms of investing, is to buy things for less than they're worth because they're either underappreciated, not understood well, or unknown. And he says that right now the default rate on securities is incredibly low, so there's fewer things that meet that criteria. And so even though he says that markets have become more efficient, it doesn't mean that there aren't any opportunities, but we probably just have to work harder at figuring out what are good investment opportunities. Howard said that what we went through in the past 18 months was not part of a normal cycle to him, because he says that normal cycles are a result of too much optimism. So let's say people are investing too much in securities, way past the fair value or intrinsic value of what things are worth, and then that begins to correct toward fair value and intrinsic value until it carries through to being underpriced, and then that corrects back toward fair value, and then again it becomes overpriced or overbought and then corrects again. So you can see with a lot of excesses there are also corrections, and this up and down is what he considers the normal cycle. And so we didn't have that because we had an event that really wasn't like what we normally would go through, because it was much like a meteor striking the earth, and that was an exogenous event. So he says that the government had to basically intervene to try to correct the situation. And then he was asked, as an investor, how do you determine intrinsic value? And Howard said, normally you would figure out the cash flows and then discount them back to the present using a fair discount rate, and also incorporate some windage for uncertainty. And he said, in a world where we have very artificially low interest rates, and so if something grows faster than the discount rate, then in theory it's worth infinity. And so it's hard to operate in a world where everything is worth infinity, because then there's no price that's too much to pay. And just to give some perspective behind this, let's say I use a conservative measure of inflation right now, and you subtract inflation from the risk-free rate to get the discount rate when you are trying to figure out the net present value of securities today, let's say. So with a conservative inflation rate of 2%, might be a little bit on the lower end of inflation, but let's go with that for now. And then if the risk-free rate of, say, a 20-year treasury bond is around 2%, then basically the discount rate is 0. And even with such a low discount rate, that basically means that no wonder things can be basically priced to infinity, because anything will basically grow probably faster than 0%, or even at negative interest rates, if that's what we're really at right now. So you can see that we're kind of stuck between a rock and a hard place if we're trying to figure out the intrinsic value of things and try to carry on as normal. Howard said that normally in the beginning of an economic upcycle, the markets tend to be lower, but he said you could say that the bad news is that the economy hasn't done much and stocks are already highly valued. Or he said you could say the good news is that stocks are already highly valued and the economic recovery lies ahead. But he also acknowledged that we're facing a prospect of some of the lowest returns in history going forward. And so he says that today, a lot of his clients have accepted that you can't get 7% returns safely and dependably. And so you have to spread the risk curve further afield and accept maybe going into other realms other than developed world stocks and bonds. I like how Howard prognosticates less, because he was asked about what he thinks of the current investing climate, and he says that instead of telling people whether to buy or sell or be risk on or off, he likes to ask people, what is the right risk posture for you, given your age, resources, needs, dependence, plans, and intestinal fortitude. And he says, what's the right amount given your risk position nowadays? So that's a really good way to think about instead what we're kind of willing to live with, given that each person's investing goals is really unique to everybody. And so he doesn't want to just give a blanket remark that could be interpreted maybe in a lot of different ways. When asked about alternative investments, which include the likes of private equity, commodities, hedge funds, real estate, derivatives, and other kinds of things, Howard said that it's not the niche it used to be 40 years ago. And he says that back then, maybe people had portfolio allocations of 60% US stocks, followed by 32% bonds, 3% emerging markets, 1% hedge funds, 1% private equity, and 1% index funds. And nowadays, it's much more mainstream than being exotic. But this is also a change from how it was maybe in the 90s, when you could invest in the S&P 500 and get 20% rates of return, and maybe some of those days are behind us. So in some ways, we have to go into maybe these areas that are not as well understood, or maybe are not as efficient as maybe things like companies in the S&P 500 might be nowadays. On the topic of diversity and inclusion, I thought it was pretty great how Howard expanded on this initiative that was launched in June 2021, where Oaktree and other capital management firms like Apollo and Ares announced a 10-year, $90 million initiative to increase awareness of the alternative investment world, and it's known as alt finance. And this is to encourage more underrepresented people to enter this investment world, and that could also have the effect of attracting more staff members to work at places like Oaktree. So all around, Howard is looking forward to increasing the representation of those who are historically underrepresented, and they're taking this initiative to historically Black colleges and universities to start with. So I think that's a great thing that they're trying to bring more diversity to the investment world. Romaine said that given the current state of markets, a lot of people have been seeking out riskier alternative things like cryptos. And he says that Howard felt that they were basically worthless back in 2017. And he asked if he still feels that way. And Howard said that he had somewhat of a knee-jerk reaction to something and he was skeptical about it because of its newness. And he says that his son Andrew lived with him during the state of affairs in 2020. And he gave him a lecture every day saying that he opined on something like Bitcoin without knowing what it's really about. And then Howard said that as a result of learning from his son who has invested in Bitcoin, he put out a memo in January this year, and maybe we should go learn from that memo what he says and thinks about Bitcoin and other cryptos nowadays. But that's basically to the extent of what Howard said about cryptos, is that he admits that he probably shouldn't have given an opinion about something that he didn't understand well enough at the time. I like how Howard said that investing is full of on the one hand and also on the other hand. And he says that there could be a lot of once-in-a-lifetime opportunities that come along every few years. And he says for companies, it could be a once-in-a-lifetime to borrow money. But on the other hand, it could also be a once-in-a-lifetime to make some really bad lending decisions. And he says that a lot of great investing comes down to being willing to do the things that nobody is willing to do. Because if you're trying to do what everybody else is eager to do, then it's hard to imagine you're going to score great bargains. And so in some ways, you want to be able to invest on the strength of the economic recovery, but then it's also a time to be careful because some of the worst of loans are made in the best of times. So he could be saying, yeah, it kind of sucks to have some FOMO that you're going through right now, but you also want to be careful how you're investing. And maybe this is a little bit foreshadowing of what could be coming. Like if we have a corporate debt crisis somewhere down the line in a few years from now. So who knows what's going to happen, but basically we should invest carefully is what my key takeaway is from Howard's messages throughout this entire fireside chat. And if you enjoyed this video or learned something, please like and subscribe and let me know in the comments if you also watched his chat and what you took away from it. I'd love to hear from you. Till next time.